capital clause, this content is discuss about the amount of authorized share capital, like how many shares a company authorize the share, or you can say that sell the share or raise the capital. So the amount of authorized share capital. It could be 1,000 shares or it could be 2,000 shares. Okay, so after that, the address clause. So it is basically the address of a registered office. Like if a company is like you can say that dealing in Karachi, so the Karachi office will be registered in the registrar office, and this is the content which is invested in MOA. And the fourth one is activity clause, like what type of activities the company will involve in. Like if it is about the manufacturing company, it is maybe producing shoes and bags and different things. So, like in which type of activity or in which type of you can say that a business involved, in which type of activity a business involved, so it will come into under this MOA. Okay. So the second document is Articles of Association. So what is it? This is also a very important document. It is very mandatory, and if you will not have it, so it means that you cannot change into limited company or you cannot build up your company. So it is also very important. So articles of association, what's the meaning of it? Are the internal rules governing the rights of the members and the running of the company. The contents are as follows. Like it is basically inform you the internal rules that how to govern your business and what are the rights of the members, what are the rights of shareholders. So all the important rights and the rules which is related to our business, which is maybe very efficient for our business to run the operation smoothly. So these are some contents which is involved in the articles of association. Okay, so it is basically define the rights and the duties of the shareholders and the rights and the duties of the directors. Okay, and it contains the regulations as to how the meetings may be called, like the annual general meeting, which is very necessary because it is kind of you can say the decision or maybe the fate of our company, because um, decision related to select the director is very crucial, because directors, or you can say that shareholders, basically bearing this responsibility, which is very crucial, and they have to be at risk, because once they selected maybe the number of directors, so it means that all the important decisions regarding financial decisions and operational decisions, or all the decisions which is very important for the business, so it will take by directors. So sometimes it is very crucial to take decisions related to directors, that which type of person would be best for our business. So these out these the stop. Okay, so the third content is capital clause, the amount of authorized share capital. So it means that uh, how many shares, how many shares a company authorize. Okay, or you can say sell or something else. You can say okay. So how many shares a company authorize or sell or raise. Okay, so this is the this stop. Start. Okay, so capital clause, this content is discuss about the amount of authorized share capital, like how many shares a company authorize the share, or you can say that sell the share or raise the capital. So the amount of authorized share capital. It could be 1,000 shares or it could be 2,000 shares. Okay, so after that, the address clause. So it is basically the address of a registered office. Like if a company is like you can say that dealing in Karachi. So the Karachi office will be registered in the registrar office, and this is the content which is invested in MOA. And the fourth one is activity clause, like what type of activities the company will involve in. Like if it is about the manufacturing company, it is maybe making, producing shoes and bags and different things. So, like in which type of activity or in which type of you can say that a business involved, in which type of activity a business involved, so it will come into under this MOA. Okay. So the second document is Articles of Association. So what is it? This is also a very important document. It is very mandatory, and if you will not have it, so it means that you cannot change into limited company, or you cannot build up your company. So it is also very important. So articles of association, what's the meaning of it? Are the internal rules governing the rights of the members and the running of the company. The contents are as follows. Like it is basically inform you the internal rules that how to govern your business and what are the rights of the members, what are the rights of shareholders. So all the important rights and the rules which is related to our business, which is maybe very efficient for our business to run the operation smoothly. So these are some contents which is involved in the articles of association. Okay. So it is basically define the rights and the duties of the shareholders and the rights and the duties of the directors. Okay. And it contains the regulations as to how the meetings may be called, like the annual general meeting, which is very necessary because it is kind of you can say the decision or maybe the fate of our company, because um, decision related to select the director is very crucial, because directors, or you can say that shareholders, basically bearing this responsibility, which is very crucial, and they have to be at risk, because once they selected maybe the number of directors. So it means that all the important decisions regarding financial decisions and operational decisions, or all the decisions which is very important for the business, so it will take by directors. So sometimes it is very crucial to take decisions related to directors, that which type of person would be best for our business. So all the regulation which is related to our general meeting, annual general meeting. In this meeting, all the shareholders, basically ordinary shareholders, give their decisions that which shareholder and which you can say which shareholder is capable to be a director, and he is capable enough to run the operations or to run our business smoothly. Okay. So the fourth content in AOA, Articles of Association, it defines the rules regarding the voting rights. So maybe you are aware that there are majorly two types of shareholders in our business. So the number one is the ordinary shareholders. So you can say that they are the real owner of the business, because they have a you can say that a right to select or to vote the directors. So that is why you can say that they are the real owners, and the other shareholder is the preference shareholders. So they are not real owners of the business, and they don't have any right of voting. So this is the basic rule of any limited company. So it is also listed in Articles of Association. And the fifth one content is it contains the rules regarding the member who failed to pay the amount due upon them, and the minimum qualification to be a director, the minimum number of shares that director must hold. So this is the, you can say that the basic requirements which have to be fulfilled by the directors if they want to be a director of the business. So all these crucial, or you can say that important definitions and important requirements which has listed in the Articles of Association. So these two documents is very necessary for limited companies. Okay, so now we are going to discuss about the type of the companies. So I just already discussed about this, that there are basically two types of limited companies. So the number one is private limited company and the second one is public limited company. Okay, so the private limited company, basically it is usually family owned business. So you have seen a lot of business which that run by a family, like if you are running a business, so you can sell your shares to your cousins and your family members, your uncles and your aunts. So these type of businesses basically private limited companies, and they are mainly owned by the family, and they can't have share capital more than $50,000. Like they cannot raise a capital which may be more than $50,000. So this is the rule for the family businesses. Okay, and they cannot issue shares to the general public, nor their share trade in stock exchange. So this is also a drawback of private limited companies, that if they want to expand more, so they cannot raise their share capital to some extent, specifically $50,000, and they can also not they can also not able to issue their shares to general public. They can only sell their shares to their family members and their friends. So private limited companies always have limited attached to its names. So we just discussed this thing earlier. So the second one is public limited company can issue their share to the general public, and their shares can be traded in the stock exchange. You know that stock exchange basically it is located in the Karachi, and there are a lot of public limited companies which do sell their shares to the general public. So if you want to maybe purchase the shares of any company, so you can um, uh, purchase their shares online, and you can also go to stock exchange office in Karachi, and you can also purchase their shares from the stock exchange company. So their authorized shares capital has to be more than 50,000. So if it is not more than 50,000, so it means that it is not a public limited company. They work under the policy of IAS Companies Act 2006 and Companies Act 1985, and they usually have the word PLC attached to its name. So I already discussed about this, that if it is public limited company, so it will end with the name of PLC, and if it is private limited company, so it will end with the name of LTD. Okay, so this is the main difference between both companies. Okay, so there are basically two types of shareholders. So the number one is ordinary shareholders, and the second is preference shareholders. So let's discuss about the shareholders. Who are shareholders? Basically, who purchase the share of your business. Okay, so these type of members are called shareholders. So ordinary shareholders are the real owners of the company and have a voting right. So because they are the real owners, so they have a voting right. They can select any director for their business, with which they take active part in the running of the business by appointing the directors, and hence they are risk bearers, because of course selecting a director for your company. So if a director is not capable, not efficient, so it means that your business will fail. So this is kind of a very, you can say that, a big risk for the ordinary shareholders. So at the time of the distribution of dividends, like at the end of the year, so what is a dividend basically? We would discuss about this. Dividend basically, you can say the amount, or you can say the percentage So at the time of the distribution of dividend, the ordinary shareholders are given the last priority, and even in the case of insolvency, the rank last after payments have been made to the creditors, long-term liabilities, and the preference shareholders. Okay, so what does it mean basically? Like if ABC company goes bankrupt, so may they have any kind of liability, like if they have a long-term liability, for example, they have long-term liability which is 100 million, okay, dollar. So company is like you can say that companies goes bankrupt, so it means that maybe company have no finance, has no finance to repay this loan to the bank, 100 million. So what will a company do? Company will sell the possessions of the company, maybe their vehicles and their offices and other possessions. So after paying 100 million, the remaining amount which you may get by selling your possession. So after cutting this 100 million, so maybe if if you will get by selling your possession, if you will get 200 million dollar, okay, so you will give 100 million dollar to the bank, and after that you will have 100 million dollar remaining amount, okay. So this 100 million will again distributed into preference shareholders, and after that if maybe some amount left, so it will distributed among ordinary shareholders. So ordinary shareholders, you can say that the last priority of the limited companies, okay. And but this is the same case in profit also. You know, if after 1 year, maybe after 5 years, if business make any if business makes any profit, so in this profit, the first one shareholders, which maybe you can say the priority of a limited company is preference shareholders. So after that, the remaining amount will be distributed in ordinary shareholders. So now let's discuss about the preference shareholders. So they are given preference over ordinary shareholders. So like I have discussed about this above, both at the time of distribution of dividends and in case of insolvency. Insolvency means bankrupt. It means that company is not willing to continue its operations, or maybe it is not able to, you can say that pay its debts. It is, you can say that making losses continuously. So that is why it goes bankrupt. So insolvency is basically bankrupt. So they usually don't have voting rights, and they receive a fixed rate of dividends are divided into four categories. So it means that if you are purchasing shares and you are preference shareholders, so it means that company will inform you that you have maybe 5% of dividend. You will have 5% of dividend, or you will have 10% or maybe 2%. So it means that you will get only 5% at the end of the you can say the year. Okay. So you cannot have more amount than this percentage. But if it is about the ordinary shareholders, so uh, they can you can say they can get a large amount from the profit of the business, because there is no percentage involved in the dividends. And a second thing, they don't have any voting rights. It means they cannot vote and they cannot decide who is the director of the business. Okay, so there are also four categories of the preference shareholders. So the number one is cumulative preference shares, non-cumulative, participating in preference shareholders. So it is not the content of your syllabus basically. So there are other two um, categories of the preference shareholder, which is redeemable preference shareholders and non-redeemable. So we will discuss about this later. So first of all, we are going to discuss about the cumulative preference shares and non-cumulative preference shares. So what is cumulative preference share? Cumulative preference shares basically are those shares who will receive the dividends whether the company is making good profits or not. Okay, so it means that if in 1 year maybe business is not able to make any profit or maybe they have loss, so what they can do is they have to pay the dividend to the cumulative preference shareholders. Like there is no, a company cannot steer by the cumulative preference shareholders. And if you are making losses or profits, cumulative preference shareholders are not concerned with this. You have to pay them their amount, their dividends. In 1 year, because of low profitability, then amount is not paid to be the compensated in the next year, and until compensated, it is treated as current liability. Okay, so for example, um, you have make any loss, like ABC company make a loss. Okay, so maybe ABC company is supposed to give 1,000 K to the cumulative preference shareholders as dividend. So for example, if ABC company will not able to pay full amount to the cumulative preference shareholders, like they cannot able to give 100K dividend to the cumulative preference shareholders. So maybe they will give 1,000, so it means 500K. So remaining 500K will be current liability. Will be current liability for the business. Okay. So this is happened in the case of cumulative preference shareholders. Cumulative preference shareholders or shares, you can say whatever you want. Okay. So how it is worked? Okay. So the non-cumulative preference shares are those which will receive a fixed rate of dividends only in the year when the company is making good profits. Like if a company may be making good profits, so only in that case, only in that scenario, non-cumulative preference shareholders have you can say that they claim that they should get a fixed rate of dividends. But if a company is not making any profit, any good profit, so it means that they are not. Okay. So the other is non-cumulative preference shares. So non-cumulative preference shares are those which will receive a fixed rate of dividends only in the year when the company is making good profit. In the year of low profits, they only receive the dividends which the company will be able to pay. The right over the remaining dividends will be lapsed and will not be compensated in the future years. So this is the just the vice versa of cumulative preference shares. Like yeah, I think we should just keep this example as it is. For example, APC company may be making losses, or maybe like they have to pay the dividend of 500K, sorry, 100K to the non-cumulative preference shareholders. Okay. So remaining 500K will be current liability for the ABC company if it is a case of cumulative preference shares. But if it is about the non-cumulative preference shareholders, so it means that company is not liable to pay remaining dividend amount to the non-cumulative preference shares. So this is the main difference in both uh, concepts. Okay. So let's discuss about the redeemable preference shares and the non-redeemable preference shares. So these all are the basically kinds or the types of the preference shareholders or preference shares. So there is no any you can say that the types of the ordinary shares in your syllabus, or basically there is no any uh, type of the ordinary shareholders basically. So these are the preference shares types, the types of the preference shareholders. So you should know about each one, because this is will be asked by the examiner in the questions. If it is about the P1, and in P2 it will ask you, examiner will ask you about this as a theory question. Okay. So the second one is redeemable preference shares. So redeemable preference shares allow for the repayment of the principal share capital to shareholders. The company may redeem these shares at an agreed value on a specified date or at the direction of the director. This is on the condition that the company is going concern. Okay, so this is also a kind of shares you will purchase if you purchase redeemable preference shares. So it means that after some time, most of the time, there is a time limit of 20 years. Okay. So it is basically a very huge benefit for the company, because, like, for example, if a company issue redeemable preference shares, like if ABC company issue 100, 100,000 shares, 100,000 redeemable. Okay. So this is basically a limited time. There is a limited time involved in these type of preference shares. So ABC company maybe inform you that after 20 years, you will have to redeem your shares. It means that after 20 years, after 20 years, you will have to take out your shares from the ABC company. Okay. So it means that after 20 years, you will no longer get any kind of profit from the ABC company. After 20 years, you can say that your shares will be expired, or you cannot, your ABC company will not liable to pay you any dividend. And after 20 years, your shares will be, you can say that pay back to you by ABC company. So this is basically redeemable preference shares. Okay. Like if it is about the ordinary shareholders, so I will purchase, if I will purchase ordinary shares, so it means that I am an owner of the company, and I can take I if I want to, you can say that a part of the company maybe more than 20 years, 30 years, 50 years, like as long as the company have going concern. Okay, so I can be the part forever in that company. But if you are purchasing redeemable preference shares, so it means that there is a time limit. After 20 years, basically 20 years is, you can say that, a maximum time limit in the case of redeemable preference shares. So after 20 years, ABC company will pay back you your preference shares. Okay, and you will no longer to get any dividend from the ABC company. So you will just take out your shares from the ABC company, and you can again invest though that amount in any other company. Okay, so maybe uh, you will have option to invest though that amount in any other company, maybe XYZ company or any other company. So you can pursue your goal. Okay, so The last one is non-redeemable. So it is very easy. This is just vice versa of redeemable preference shares. So non-redeemable preference shares basically are those shares that cannot be redeemed or repurchased by the issuing company at a fixed rate. Non-redeemable preference shares help companies by providing stability during time of inflations. Like if a business want so sorry for the inconvenience, student. Okay, so the non-redeemable redeemable preference share is vice versa of this redeemable preference share, that you cannot redeem your preference share after a certain time limit. Okay. So the next one is debentures. This is also a kind of, you can say, a source of raising your capital, but it is not they are not basically your owner, the owner of your company. This is basically just a loan. Okay, so debentures is kind of a loan. So IOU certificates of the company, they are long-term liabilities on which a fixed rate of interest. So like if a business wants to expand, so if they want to raise their capital, so they will go to a bank, and after some, you can say, the documentation, so business will be able to get a amount from the bank, so they can get they can get amount, and after that they can expand or they can invest that amount into the business, and after that business is basically liable to pay a certain amount of uh, you can say the interest to the bank. So this is basically debenture is also same, but it is a kind of certificates, and it is basically a bit basically to the long term liability, and which you have to pay a fixed rate of interest in the given amount. And for example, you will take out 500 million from the debentures. So maybe if they say that the interest rate is 10%. So just impose this 10% to 500 million. Okay. So if it is 500 million, so you have to pay 50 million as your interest. Stop. Okay, so after studying about the different types of shares, preference shares and ordinary shares, and there are also some kinds of preference shares. So after that, there is also like another concept, which is debentures. So debenture is simply a kind of loan. Like if you don't want to, make anyone the part of your like the part of your business, or if you don't want to share your profit as dividend to the shareholders, if it is ordinary shareholders or if it is preference shareholders, so you can go with debentures also. You can get amount as a loan, and you will have a fixed rate of interest that you have to pay the debenture company after 1 month. So the rate of interest is fixed, like if it is set by the debenture company, that if it is 5%, so it means that you have to pay 5%. Okay, so if you want to raise $500 million, so you don't want to raise capital, you don't want to raise capital, you don't want to use ordinary shares, or you don't want to sell the shares to preference shareholders, so you will have an other option, which is debenture. So you can just go to debenture company, and you can take 500 million loan after some documentations, and you will have to pay a fixed interest rate to the debenture company. So it is very simple. There is no such, you can say, the critical content or critical information involved in the debentures concept. So this is just, you can say that a kind of loan. You can say that a bank loan. Okay, so debenture, you can repay your loan in 25 years also. You know that there are very long-term loans. Okay. So after studying all the concept which is related to raising capital, so let's talk about the reserves revenues basically. So what are the reserves revenue? Are the amounts set aside by the company from trading activities of the business, like the profit. Okay. So after making profit, business uh tend to, you can say that, set aside some amounts from the profits for the future prospects of the company. Like if in the future maybe company wants to expand, maybe company wants to purchase any fixed asset which is maybe necessary for company's growth. So if a company don't want to sell their shares, or maybe they don't want to take out any loan, so business if business just you can say that set aside any specific amount from their profit, so it will be very beneficial for the business, because they don't have to pay any interest rates to debentures, or don't need to pay any amount or any dividend to the shareholders, which may be ordinary shareholders or which may be preference shareholders. Okay, so this is very important for the business to like just keep some amount from the profits. Okay, so basically there are basically three types of reserves, but in your course we will discuss about only general reserves and the retained profits. So you may aware the concept of retained profits, but maybe you may don't know about the general reserves, so we will discuss about the general reserves. Okay. So general reserves are the amount that the company set aside for the purpose of expansion or to combat a problem that might arise in the future. So what type of problems which may be arise in the future for the companies? For example, we were discussing about the preference shareholders, that we have to pay a dividend amount to the preference shareholders. They are our priority. It doesn't mean that we are if we are not making any profit, or maybe we are making any losses, so we will have to pay a specific dividend to that kind of shareholders. So this is also a problem. So if a business have general reserves, so they can easily just take this amount to into the business from the business, and they can give the dividend to the preference shareholders. Okay, so by doing this, they can decrease their liability. So in retained profits, it is are the leftover which are plowed back into the company to finance the running of the company in an effective manner. So retained earning is basically a pure profit for the business, which is you can say that pure from any interest or any dividend. Okay, so we just discuss about the authorized share capital. I think in maybe to number 3 or number 4 slide. So this is basically the maximum amount of shares that a company is allowed to issue. Okay, so let's discuss about the authorized share capital. What is authorized share capital? So authorized share capital basically represent the maximum amount of share capital which a company is permitted to issue by its MOA, basically Memorandum of Association. It is also now as nominal capital or registered capital, as it represents is a nominal amount of capital with which the company is registered. So the authorized share capital appears by way of note to the statement of financial position. It is not part of the figure needed to balance the statement of financial position. So like uh, if it is a private limited company, so we can only raise, I think I will show you this so you can better understand about the concept of authorized share capital. So here you can see that if it is a private limited company, so they can only they can't have authorized share capital more than 50,000. Okay, so authorized share capital basically the maximum amount of shares which a company can issue. Okay, but if it is about the public limited company, so you should raise the capital of 50,000 above $50,000. Okay, so this is basically authorized share capital. There is no any difficulty, or there is no any very complicated logic involved in this concept. Okay. So this is our authorized share capital. Okay. So after that, we are going to discuss about the issued share capital. Issued share capital. So what is it? Like it is very easy that the concept of issued share capital. Basically, issued share capital is a part of the authorized share capital which the company has already issued to the general public. For example, a company may have authority to issue 50,000 shares to the to maybe to the friends and family. So if they issue only 100 or maybe 1,000 shares, if ABC company issues 100 million shares to the general public, so this is basically issued share capital. The capital which you issued, which you issued to the in the stock exchange company, and your you can say that potential shareholders can purchase your shares from the stock exchange company. So it means that this is simply your issued share capital, the amount of share you just issued to the general public. So it is basically issued share capital. So there is nothing complicated in this concept. Okay. So after that, the second, that you can say the type of the share capital is called up. So what is basically called up share capital? It is very simple, is a part of the issued share capital that the company has asked to pay. For example, your potential shareholders has become your shareholders in real, and they purchased 100 million shares, okay, but they didn't maybe pay you any amount. So after some time, you will ask to your shareholders to pay that amount to the company. So it is just as simple as that, that this amount is basically called up share capital, which is called by a company to pay the you can say the amount of the shares which they may be purchased by your shareholders. So you just call the amount, you just ask your shareholders to pay that amount to the company. Okay. So after that, the third one is paid up. So paid up is very simple also. Paid up share capital, which is paid by your shareholders. Okay. Okay. For example, uh, maybe you issued 100 million shares, okay, to the general public. Sorry for the to make dirty what is happening. Okay. For example, ABC company issues 100 million. Just remind one thing, that 100 million, it is not in the dollar. Okay. Why it is not in the dollar? Because this is the number of shares. You cannot write dollar sign with this. It is number of shares which a company issues. Okay. So for example, a company issues $100 million to the general public. And after that, only you can say that only $50 million has purchased by the shareholders, and only, for example, your one shares face value, or you can say the nominal value. What is the nominal value or share value? Basically, nominal or share value is the value of your one share. Like, what is the amount of what is the amount uh, shareholders have to pay you in order to get one share of your company. Okay. So if it is about one share, so maybe you are selling your one share into to $2. So it means that if I am a shareholder and I want to purchase 100 shares of your company, so it means that I have to divide it by $2. 100 is the share which I am going to purchase, and the nominal or the face value of one share is $2. So it means that I have to pay $200. Okay, it is very simple. So, for example, a company issues 100 million, but a company may be only able to sell 50 million shares 50 million shares to the shareholders. Okay. So it means that if we multiplied 50 million by the two, so it means that we have $100 million, $100 million amount in the form of capital. Okay. So this is basically paid up capital. So if maybe a company successful to sell $100 million to shareholders, so what does it mean? So it means that we have to multiply 100 multiply by 2. So we have $200 million. So it means that we have now paid up share capital is $200 million. So this is very simple. So it doesn't mean that company is always successful to sell their